Milton Friedman, The Great Contraction, 1929–1933, New Edition. In The Great Contraction, 1929–1933, New Edition, Milton Friedman offers insights into the economic collapse of this era and highlights the inherent issues of fiat money systems. The book discusses the challenges faced in halting economic meltdowns and ensuring a steady, progressive economy during times of crisis. It emphasizes the importance of wise political and economic decisions in stabilizing an economy, as well as the significant impacts of massive spending on long-term economic prospects. In this summary, we will delve into the dangers of huge public and private debt, the need for effective investment planning, and the vital role of diversification and proper asset allocation in maintaining a healthy financial future.
The Great Reflation. The U.S. government spent billions of dollars on bailouts, stimulus spending, and tax credits to avert another Great Depression during the Great Recession of 2008 to 2009. However, the long-term effects of such massive spending are unclear and could create instability due to inflation and the potential for economic bubbles. The government's approach has been successful in halting a financial meltdown, but it has not delivered a steady, progressive economy. The Great Reflation means that the public and private debt, a shaky global economy, and a weak dollar could lead to eventual instability. Wise economic and political decisions must be made in the next few years to ensure financial stability. Investors must monitor specific signals to make informed decisions and protect their capital. The perilous path of fiat money. The use of fiat money by governments has led to hyperinflation and economic instability throughout history. The aftermath of World War I and the fall of the gold standard led to inflation and economic bubbles that eventually culminated in the 1929 crash. In the 60s, the decision to tolerate some inflation for greater employment led to a dollar gold peg that was eventually unsustainable. Since then, inflation has become a global economic fact of life. However, excessive inflation can have disastrous consequences, as evidenced by the credit implosion of 2008. The Great Reflation aims to balance the need for economic recovery through asset price increases with the need to prevent runaway inflation. The U.S. is currently converting private debt into public debt, which could have significant implications for continued fiscal deficits. Investors must understand the lessons of history to anticipate changes in the global economic system. Preserving wealth in times of change. The Great Reflation experiment makes wealth preservation a top priority for investors. Asset classes in the future will experience many short-lived booms. Therefore, focus on long-term investments and resist the urge to follow the crowd. Plan, exercise persistence, caution, and judgment to achieve financial goals. Determine investment objectives, risk tolerance, and time horizons. Liquidity is especially important for short-term investors. Identify assets to hold, in what proportions, and when to change those proportions. Prudent asset allocation is critical, and diversification remains a pivotal investment principle. Watch for signs of market changes, such as fluctuations in interest rates, that indicate a need to adjust the investment strategy. America will recover, but the pace and tenacity of the rebound are uncertain. Proper investment for guaranteed returns. Investing in the stock market, bonds, the US dollar, gold, commodities, and real estate is a wise decision once done correctly. With the right tools, exposure to quality stocks, and evaluation of assets, profits are guaranteed. Investing is a crucial aspect of wealth creation, and several investment options need to be considered to secure desirable returns. Among these options are the stock market, bonds, the US dollar, gold, commodities, and real estate. While these investment types come with different risks and benefits, proper selection and evaluation guarantee profits. One of the best investment options is the stock market, which generates returns through value increases and dividends. Over 10 years, the stock market's average return is higher than that of bonds, with fewer risks. The past 174 years have shown that bear markets average a 37% decrease, while bull markets show a 114% increase. However, investors should use 4 tools to determine when and how to increase or decrease exposure to the stock market. These tools include focusing on leading market indicators, valuing companies based on money made, and interest rate adjusted for risk, investment psychology, and statistical, technical, analysis. Successful investors should also consider investing in good quality stocks. Bonds are another investment alternative that can add income to a portfolio but require careful consideration. Great inflation could be harmful to bonds, and investors need to consider 2 factors: the bond's tenor and the bond issuer's credit quality. Bond investors should also monitor the trend in interest rates and consider investing in Treasury inflation-protected securities, TIPS, to hedge against inflation. The US dollar may have lost a significant portion of its value in the past, but it is still the world's reserve currency, making it a promising investment option. It is different from other currencies and largely impacts the international economy by pricing most internationally traded goods and being maintained in central banks' reserves. Investors should, however, be cautious given the recent high debts level to GDP, which sends shivers throughout the global economy. Gold offers one of the best hedges against inflation, but as an investment, it is only better than treasuries. However, if you fear a financial catastrophe, investing in gold via futures contracts, exchange-traded funds, ETFs, or mutual funds is a wise choice. Investing in physical assets, such as commodities like oil, coffee, copper, and pork bellies, can offer negative correlation with stocks and bonds. They need to be replenished, and in a world where resources demand keeps increasing, investing in commodities presents an appealing short-term case. Finally, investing in real estate is an excellent decision as it guarantees a roof over your head. Investors should, however, be cautious given the recent fall in home prices and the prospect that many aging people may have to sell their homes to pay for retirement. Investing is a guaranteed way of making more money and securing the future, but it requires proper analysis, evaluation, and risk management. Investors need to consider the stock market, bonds, the US dollar, gold, commodities, and real estate, and use the right tools to make informed decisions. The future of the U.S. economy. The U.S. economy's weaknesses have been exposed by recent economic upheavals. Although the Great Reflation prevented an immediate financial meltdown, future prospects aren't optimistic. Mounting public debt restricts the country's options for addressing its challenges. Meanwhile, the aging population implies that, by 2050, the number of workers who support retirees will be nearly twice the number in 2009. Since manufacturing accounts for only 12% of the economy, the U.S. must focus on short-term growth by investing in leading industries such as technology and energy, while reducing debt via smart cost-cutting and tax increases. Investors should consider equities of companies in commodity-producing nations, while small U.S. firms are likely to provide excellent returns, especially those utilizing state-of-the-art alternative technologies.
Milton Friedman's The Great Contraction, 1929–1933, new edition, elaborates on the consequences of the precarious economic policies that have failed to provide long-term stability. The book emphasizes that the primary goal for investors must be wealth preservation, which entails a cautious, informed approach to navigating the complex financial landscape. With the lingering threat of economic crises, investors are urged to focus on asset allocation, diversification, and the analysis of various investment options such as equities, bonds, currencies, gold, commodities, and real estate. As the course of history shows, only through deliberate planning, vigilance, and persistence can individuals succeed in safeguarding their financial well-being amid inevitable socio-economic changes.